Equities, another difficult day. We've seen selling for the last several weeks, but really it's taken off over the last several sessions, and you really can pinpoint it to FOMC. But I think ultimately right now it's starting to exaggerate, and there's a couple of different reasons for it doing so. First of all, the technicals, we look at it, we traded through 2,500, a level that probably some thought was going to be a good buying level. And, shortly after, we're now trading close to 2,400. So the market definitely picking up some steam here as we head into the weekend on the downside. I think that right now, breaking out of the range, we're kind of in a free fall. Yeah, there's going to be some support, but I think that most buyers are now looking at it, waiting for the dust to settle, knowing they don't have to be aggressive. This isn't December of 2017 or 16 where you're trying to get in before it gets too high. This is kind of a moment where buyers can be a little more cautious and a little bit, more frugal. They don't have to jump in and worry about missing the move. More off, so they can worry about the market going down another 100 points in the S&Ps, and that is what we're seeing. So right now we're seeing big selling, big free fall, and I think the bids are all kind of backing out here. We'll wait and see when we get to 2,400 how that level holds. But right now that seems to be the next target. And if you look at the VIX index, highest since February, we're at the 30 level, something we probably didn't expect to see, without some kind of major event. Unless you want to look at government shutdown as an event, unless you want to look at what the post-FOMC trade as an event, maybe those are. I think that right now, from the breaking out of the range point, the market could have telegraphed that, so I don't know if that's certainly coming out of left field, but I think that the volatility remaining this high suggests that there is fear of us going lower, and it's more of a risk-off trade now and a position trade than anything else. And if volatility stays this high, it means that the equity levels are probably going to continue to decline. And let's look at some of that selling. Where is that money going, or what are we seeing here? Obviously, I mentioned the government shutdown. We've got risks post FOMC. The market had to reprice for less or no hikes in 2019. And I think the equity markets right now are fearful of lack of growth and lack of what the Fed had talked to us about. Risks are now to the downside as opposed to risks holding neutral or risks, to the economy expanding. So I think that is something that has really grabbed the headlines. You've always got trade tensions going on until those get resolved. And then on the other side, you've got treasuries rallying, you've got gold, which was down today, but has been trending higher. So you've got those riskless assets bidding, and you've got the risk assets getting hit. And lastly, we can't forget the year end. You see a lot of stock selling into year end. That could change. That could flip very quickly after the first of the year. Some of this technical selling may be involved. It gets exaggerated with the idea that there's going to be some tax implications with the new tax laws. So there's that to throw into the mix as well. We do have another week until year end, but I think that if you start to see the technicals and the momentum, maybe you wanted to get out a little earlier. But certainly, I think some of this selling will be reversed after the first of the year. That level we're going to be watching very closely is 2,400. You get below that, very quickly as we got through 2,500, this thing could really take off. So downsiders can keep an eye, buyers can watch and wait. Sellers, you may have to be in there pretty quick.